And thanks everyone for joining. Really good to see that people are joining from various parts of the country, and Nifty at 20,000, it's always a good time to invest or to think, whether you should invest or not. So before we start this session, I think Aisha briefly introduced about me. My background, an equity research analyst by training, did that for 15 years almost with investment banks like Jefferies, Societe Generale, Lehman Brothers, and so on, and then jumped on to full-time into Tawaga Advisory. What we do at Tawaga is we are a SEBI-registered investment advisor. So we have our flagship product, which is the robo-advisory product through which you can set up your own financial goals and that can go into basket of exchange-traded funds. Then second, we also do customized advisory where there's a need for people to go on, in terms of getting their personal investment advisory. We are SEBI registered investment advisor. That's the license under which we operate. So before we start, just a quick disclaimer that today's session is mostly for educational purposes only, and nobody should consider anything as investment advice. If there's any doubt, you should reach out to support@tawaga.com for any further queries which you might or might not have. So I think one of the biggest dilemma that every one of us has or would have had at some point of time is that how to really start investing, because let's say if there are 100 instruments available, you would not like to land up saying that okay, I'll have the 98 number performing instrument or 99th number performing instruments. Everybody would like to take a moonshot and say that okay, I'll pick up one instrument which will serve best for my needs, and then probably just be the best performing investment vehicle as well. And we have to understand the risks as well which are involved when choosing any particular investment instrument per se. So that's where it becomes like really a moonshot in terms of how you start investing. And that's number one deterrent for a lot of people to start investing as well, because at early stage of their career they are just too embarrassed to acknowledge that probably this is not one of the things that they had considered or they know completely about. And it's absolutely normal. There shouldn't be any shame attached to it, but it's just the reservation of not opening up or not finding the right information, which is a big deterrent. The bigger problem happens when you start scouting for investment ideas on social media. Now, people look for validation there. That's the bigger problem. You buy a stock, any particular stock, and then you go out in social media, ask about opinion and see, what experts are saying. And then other things you try to figure out good, bad, ugly. It's a very much like a self-learning DIY process, nothing right or wrong about it. It's just that it's very time consuming and it might or might not be very specific in many aspects. Some solutions, of course, not everything on social media is bad. There are many new age digital solutions, which are of course better. And there are a few, I won't name some of them, but who are doing excellent work in terms of educating people in terms of, how you sort of start investing. But the biggest dilemma, as I discussed at the start, is like really how do you pick the best performing instrument? And especially when, let's say, Nifty is at all-time high, it actually probably closed at 20,100 plus today. So, I mean, so that's the time when you are like, would you like to like punt and take a call that, okay, it's going to fall from here, so probably I'll wait it out and see, when do I start investing? Or you say, okay, I'm there for the long run and I want my money to work for me essentially in the longer run. So how do I consider about it? So now, for the sake of this session today, I've like covered up a small exercise and I'll start talking about it. So if you're not able to understand anything in between, just block me. But hopefully, that at the end of this exercise, it should take not more than 15 to 20 minutes of what we are going to discuss right now. You should be very clear about how to look at investing, timing, allocation, and many other factors here. So let's start with the case study. So first idea is that you have, let's say, 100 rupees or $100 or 100 yen or whatever, and you divide in two equal assets. You say one will go into equity and one will go into gold. And the whole idea for division is very simple that, you say that, okay, fine, I don't have a very sort of, aggressive opinion about anything. I'll go by grandma's wisdom of investing in gold, and I'll go by, new age wisdom of investing into Nifty 50 as well. And because I don't know how to like bucketize that, how to do asset allocation and how to change that, I'm just going to go with 50-50 allocation there. So there's a specific time frame that I've considered, and you'll know that why I'm like talking about a certain specific time frame. I've considered it as January 2018, and that's quite 5, 6 years back in time. But idea is that the way you are thinking and making choices in January 2018, where you have no idea how the world will shape up, and then you start investing. So what happens now? Essentially, suddenly come 2020. For those of you who are old enough to realize that what happened in March 2020 really, so what happened is, in March 2020, there was a sudden downfall in the market. And essentially, no matter, how you would have invested 50-50, you would have seen a drawdown in your portfolio. Now, drawdown just means that, let's say if you were at 100 rupees in, let's say, January, February 2020, suddenly it would go down 8%. It would be 92 rupees or something, because of March sell-off. Now the sell-off impacted equities, bonds, gold, and every other asset class in the world. March 2020 was, of course, the unfortunate month where the world started discovering about COVID, and suddenly lockdowns were announced, and then the stock market reacted very badly around it. So what would happen, at the time of exit, and what we considered as exit, that in the exit date, it's essentially December 2020, your gold will be 57% because gold was probably a better performing, or gold, it held up better, and the weight of gold increased, and your Nifty actually reduced 43 odd percent. Now, there's nothing right or wrong around it itself. It's just an example that we are making, that, okay, this is how the world would have changed around you in terms of if you did like equal asset allocation going into equity and gold. Now, what we really are trying to learn here is that rebalancing is actually ensuring some target allocation. That's what we are trying to trying to figure out. And then second is what happens when rebalancing actually happens. So if had we rebalanced, could we have saved ourselves from the drawdowns or not really? So it all depends on your financial goals as well somewhere. And then the whole idea comes is that what will happen about your financial goals, and what is the right way of setting up overall financial goals and overall asset allocation. So this is one of the things which comes as a rescue there, because let's say even if you would have gone by grandma's wisdom there, you would have actually saved more money, you would have saved better portfolio at the time of March 2020 sell-off. While if you would have gone with the new age generation of investing into Nifty 50, you would have seen more drawdown, going in your portfolio. And there's no right or wrong balance. Even you would have, if you would have rebalanced, there's no empirical evidence which suggests that, okay, this would have made a huge difference in your sort of, portfolio, and this would have done this and that wonders. So now one of the ways is actually to think about glide path investing. Now, for people who are investing for a while, have you heard the word glide path investing earlier? So for anybody who has heard, I'm happy to hear some comments on the chat of what do you understand by glide path investing really. Is there anyone who has heard this word earlier? Okay. Fair. So let me just spend some time on it. So what happens is in glide path investing, and this is more pertaining to your financial goals essentially. So let me just go back a couple of slides now. So what you look at this slide here is this red sort of bar here, and your portfolio is down 8 odd percent, let's say, from your February 2020 levels, or wherever we are thinking, it is down from. Now, what happens here really is once the portfolio is down, if you have a financial goal set up for, let's say, June 2020, you have to pay for your children's education fees, or you have to go for holidays, or you have to pay for your housing loan, or whatever you are planning for, or whatever. Suddenly you're seeing your sort of portfolio going down by almost 8 odd percent. And this is where the problem arises, that, you have some financial goals staring at you, and suddenly you're investing in a very safe manner, either in Nifty 50 or in gold, but suddenly you're short of funds because you have to pay for these commitments and so on. So what glide path investing essentially suggests is that you set up your goals in a manner so that you're taking more risk when you are further away from your goals. So the right hand chart, if you look at it, it essentially says that if you're 7 years away from your financial goals, so you're making more and more investments going into equity ETFs, you're making more taking more risk essentially. But when you're going closer and closer to your financial goals, this is where you're reducing your risk, which means that you're rebalancing in a manner so that as you're coming closer to your financial goals, you are saving more for your you're saving more to keep your principal protected. And that's the whole idea of glide path investing, that it's essentially a time varying asset allocation strategy. And what it means is that, let's say a lot of people ask us that, how should we start investing? How should we think about, where to invest and how much to invest? The whole idea is that if you start thinking about personal finance as a one-on-one approach and think that, okay, my financial goal is quite away from me, 6 or 7 years away, I'll hence take more equity risk for it. I want to buy a house in 7 years' time. I want to get married in 6, 7 years' time. I want to go to Bahamas, travel the world, take a year off, from my career and then travel and do this, that. It's 6, 7 years away. Fine, I'll take more risk. I'll probably be more equity sort of, heavy sort of a portfolio for that for particular financial goal. But if my financial goal is very close, let's say in 3 years' time, I have to pay for my home loan EMI, or I have to pay for my children's fees the next year or something. And these are the times when you have to take your risk in a very different manner. You have to be very conservative for those financial goals and keep the equity allocation low and keep more allocation going to debt or gold ETFs and so on. And that's the whole idea of, asset allocation. That is the whole idea of separating it with financial goals. And that is the whole idea, how you can adopt like glide path investing approach and think about that, how should you invest, how much you should invest. Because let's say if you're not consulting any advisor, if you are not consulting any friend who's an educated one on these issues, you are actually taking huge risk and trying to figure out, how these things will play out, while not even knowing, what exactly will work out for you or might not work out for you. So that's the whole idea of thinking about like glide path investing approach. I hope this is a little bit clear. If not, like I'm happy to take that in a Q&A session and then discuss it further. So essentially, there's no one size fits all. You as an individual are very different from your friend. You might have very high responsibilities of parents, dependents, and so on, while your friend might or might not have that. Second is, even for your different financial goals, your risk appetite might or might not be very different. You might have some financial goal going for holidays in Bahamas, buying a house in 3, 5, 7 years time, while you might not have any, sort of a very different risk appetite when it comes to next year financial goals, where you definitely need the cash in hand. So that ways, you might actually think about maybe fixed deposits or ultra conservative approach for that financial goal and not leave anything for last moment. And that's the whole idea of separating financial goals and making and taking a portfolio approach around it, that you are your own portfolio manager, and that's the way you should think about it. No ifs and buts, but you should not discuss about what your friends are doing and everything. You have to take care of your own financial goals, your own portfolios, and then go from there. Now, one of the things which is very interesting, which happens, and I'm just taking to the next level now of what will happen, if you start diversifying and everything. For those of you with a little bit of mathematics background, you might find it easier to understand that risk in financial terms, we measure it as annualized 3-year rolling basis. It's the standard deviation of daily returns, essentially. So what is possible that if you like hedge, or if you like make a proper portfolio, you can actually reduce the risk manifold from what Nifty 50 or even the market is presenting. So what you're seeing here on the left is, some combination of ETFs. That's our own internal sort of allocation strategy through which we have managed to reduce the risk manifold from the market while not necessarily compromising on returns. Now, one interesting bit that we lost out, and then, which was just like, what would happen? Like a lot of people churn their portfolio. The biggest question that we get asked as well is that, what if I like churn my portfolio, and what will have actually happened? What is interesting, and again, empirical data can like really vary depending on which time frames are you would have chosen and everything. So in this exercise, what we had done was that we kept like 50-50 as mostly as, sort of rebalancing and everything. And we actually sold, the better performing asset class and bought the not so better performing asset class during that one. So during the time frame that we had discussed from January till like, let's say December 2020, I mean, in fact, we would have seen like sharper drawdown as well, even if we would have rebalanced. Now, just one use case, just one, nothing to suggest or make an argument because time frames can change, some other instruments can change, and you can argue it in many various avatars. But from this example, we are actually learning that essentially rebalancing or, high churn on your portfolio might or might not save you from drawdown. You have to keep your financial goals in mind. And that is the biggest thing that you have to sort of lever for you to play out with. Interestingly, so for those of you interested in math and everything, there's something called modern portfolio theory in quantitative finance. Anybody who's interested, should read a little bit about it. of how to think about risk reward portfolios and everything. For the sake of this conversation, I'll skip this slide totally. But really want to leave this topic on some sort of thoughts for everybody to think that how many stocks are good for diversification. Now, this is one thing that a lot of in the pandemic, a lot of people were dealing with their own portfolio. So how do you look at number of stocks that are good for your portfolio? Are you able to achieve the right diversification? Are 15 is the right number, or 25, or 88? Anybody wants to take a guess there? I'm happy to hear you out. What you think is the right number for taking diversification. Ideally, for your portfolio size, whatever number it is, what could be the right number of stocks and everything? 20, 10, 20, sure, 12, fine. Veena says 15, Santosh is at 15. Okay. Anybody wants to come and say why they selected then that particular number? Santosh, Veena, anyone, please raise your hand and just let us know why do you say 20, Abhishek? Why 20? Anyone? Harish says too much diversification dilutes the goal. That's right, actually, Harish. You're spot on. Right amount of diversification so that you're able to reduce the risk. Too much of diversification ultimately leads you to nothing more than index returns, actually. So that's the way it happens. So what's the right number there? 10 to 15. Okay, I'll answer it. If nobody's coming on call, two stocks for every. Abhishek, that's a very good approach because essentially, there are many industries where winner takes it all market share, and people who take market share, they enjoy actually disproportionate amount of moat in the business as well. So probably if you're able to, let's say, pick up anything in telecom, you are very bullish on telecom as a sector, then you'll probably look at the market winners and, probably stick to that rather than taking a punt on going downwards. Because let's say you're not an expert on telecom, or if you pick up anything in banking sector, you might look at market leaders and then start to take a punt on that. Santosh, because any perform, fail or not perform? Yeah, I mean, that's always the case because, I mean, there are so many exogenous factors under which you invest into the market. So that's the right case. But yeah, I mean, the answer, right answer to it is there's no right answer. The idea is that one is you should be able to diversify well. You should not over diversify, because if you end up over diversifying, you'll actually end up like not more than Nifty 50 returns. So you might as well have that. 15 to 20 or 10 to 15, probably that's the range my personal comfort lies, because these are the companies that you can track. These are the companies where you can take concentrated bets on. And these are the companies that you want to learn in the longer run. And I'll tell you, I keep joking it internally, like even 15, 17 years back when I was covering Asian Paints, Asian Paints was Asian Paints. It was a very good stock even that point of time. ITC was ITC even that point of time. Reliance Industries, of course, changed its avatar in many avatar with the telecom and other things coming in. But a lot of these companies have maintained their original avatar, from what they were 15, 17 years back as well. So why change unnecessarily, where Asian Paints and ITC and Nestle India or Colgate and, some of these names, they'll probably not change their DNA even 10, 15 years from now. So if you understand these companies well, if you understand the stock drivers well, and you start building up that thesis, you're there for the long run, and you'll probably, sort of be very much beneficiary of that. Now, the second question is how many SIPs are good? So anybody wants to take a guess there? Okay, 5. 3 to 5, fine. As per your goals, Dinesh, you're right. Actually, as per your goals is the right answer to that. And that's the whole idea that, once you set up your goals separately, try to sort of, try to set around and then build a portfolio around it, basically. Let's say you set up 5, 7 year goals, then you start saving for that, do an SIP for that. Opportunistic SIP is better, probably, yes. So idea is that if you follow markets regularly, you might find the right time and everything to enter and exit. But if your day job is not following markets, then you might find it very difficult as well. So that's the time when you might or might not want to get, sort of into that exposure. But it's very important to like understand the market risk, basically, which is there in the market. SIPs actually, reduce and stream some of that market risk. It's important to understand the cost structures of various funds And it's also important to understand any alternatives which can be present as well. So let's say if you want to buy any large cap fund, is there an alternative in the form of exchange traded funds? And you can, go around it as well. But the idea is 3 to 5, let's say, again, there's no right or wrong answer to it, but 3 to 5, let's say if you are able to set aside your personal goals and you start saving for these personal goals in a very separate manner, then 3 to 5 SIPs is the right number. It totally depends on your financial goals. It totally depends on your financial goals as well at the end of the day. That let's say if there's some financial goal hitting, which SIP to like stop, which to liquidate, and where's your emergency fund and how to like segregate around it, and then nothing more than that. Yeah. Yeah, that's it from my side. So thanks a lot for